I know that a lot of you have been asking about what is going on with gold and silver. First of all, you need to understand they're the spot markets, but I'm going to give you a technical lesson today because after all, how many times can you be lied to while you do not know the truth? And the answer is simple, every single time. And I'm just glancing up and seeing some of the questions that have come in. And the second question down the list is, could you please also talk about the crash in silver? So today I'm going to talk about both of what's happening because we aren't talking about, and we're going to talk about this too. I'm going to show you this too. We're not talking about the physical markets. We are talking about the spot markets. But of course, you have been trained to think that that's representative of gold and silver, when in reality, it is simply a trading product that is designed for perception management. That means that they want to make sure that you don't own physical metals, because after all, they need your wealth in the system because then it's much easier to inflate away. This stuff, physical in your possession, runs zero counterparty risk and also runs zero inflation risk. They cannot inflate this away, and it's not because I or anybody else says so. That's because they are both used in every single sector of the global economy. So that means that you have full functionality and full demand. So let's just go to the charts, and I'm going to start with a long-term chart because while we've talked about this in the past, I want to make sure that you understand it. And there is this blue line that runs underneath all of these choppy lines, and that would be the 200-day moving average. So what that means is every day for 200 days, they total up where spot silver or spot gold or this is true for anything on Wall Street. Wherever the price closed, they total it up for 200 days, they divide it by 200, and it gives you an average. And that 200-day moving average, I've told you this before, but it acts like a rudder on a ship so that there's only so far above or below that average that it can go before it always comes back to that average. So here are just some examples on this long-term chart. This is a silver. This happens to be a silver chart. Okay, so you can see where these boxes are, and if you can see that blue line, there's only so far above or below that it goes before it comes back to that line, back and forth. Now, 10% away from that line is already considered a lot. So we have to keep that in mind as we move forward, but can you see what I'm talking about? And with the correction, in other words, the spot price of silver coming back down, well, there's always, I've talked about support and resistance, right? So here's how that works, right? Let's say support, and you were going to buy something, like you were going to buy spot silver when it was $36 an ounce, and you didn't do it. And then it shot all the way up past 50. Well, you're going, man, if it ever gets that low again, I'm going to buy it, right? So that creates a pool of buyers at that level. And so spot goes down, dips into that pool. There are more buyers. It pushes the price up. Spot goes down, dips into that pool. It needs to use up that pool of buyers before it can go to the downside. And the reverse is true on the top, and that's called resistance. So let's say you were going to sell it at over 50. And remember, 50 was the very long-term peak in that triple cup formation on the long-term spot silver chart. I've shown you that a gazillion times. I'll show it to you another gazillion. But that creates a pool of sellers up at that higher level. So spot goes in, dips into that pool of sellers, that pushes the price down, which is what we're seeing. That's one of the things that we're seeing right now. It goes up, it dips into that pool. When it uses up that pool of sellers, that's when it can break free and go to the other side. So we could potentially be testing that silver contract at that support level, and we'll get into it. I'm going to go to a closer chart right now. This is a 1-year chart, and you can see in this case that red line. Let's see, this is spot silver. Okay, you can see that red line is the 200-day moving average. That blue line is the 50-day moving average. When the spot price is above that 200-day moving average and the 50-day moving average, that is very, very bullish. But can you see how far stretched the spot market was from that 200-day moving average? And even going back through last night, because these graphs are from yesterday, right? I wanted to be as current as possible to show you this. It's still 22% above that 200-day moving average. So I frankly, knowing that this is a trading instrument and that it does not represent the true fundamental value of an ounce of silver, which is somewhere around $2,000, this is an opportunity to get in. Because with silver, for me personally, and you have to do whatever you're comfortable with, so I can just speak for myself. But for me personally, silver is my barterable position. So I don't really do collectible silver. I'm just looking for a variety of sizes. And in this case, I don't care if it's new. I don't care if it's old. I only really kind of care about the weight. And beyond that, it could be in any form, absolutely any form. Silver and gold at its base is monetary. So it's important to understand that. But can you see how far away we still are from that 200-day moving average? So if it corrects back down to that, if it even goes below it, I'm okay, because look at the direction of the 50-day as well as the 200-day moving average. They're in an upward trajectory, right? So remember, there's only so far above or below that it can go before it comes back to that average. So understanding the direction of that average is also really important to take note of. So this is really what's happening with spot silver. Additionally, remember, did the piece on backwardation come out yet, or is that coming out Saturday? All right. Make sure that you watch the piece on backwardation. Now, backwardation, this is true for both gold and silver, is when the current spot price is higher than the futures price. So buying silver out in the future. Because what's been happening with extreme demand is that people don't trust those future promises, and you shouldn't. We've had some entities, some large entities that usually, contracts for silver are like 5,000 ounces. They have different size contracts and they're making them smaller and smaller so you guys can participate. That's just a contract. It doesn't mean anything. But backwardation in both gold and silver is flippin' scary for LBMA or the COMEX or any entity that must deliver out that physical gold and silver, because it's very, very hard to come by the physical market, especially in the U.S., which is primarily a paper contract market. Don't be fooled. Take advantage of it, but don't be fooled, because they want you to stay away from it. And a lot of what's happening, and I think I saw it this morning, so I stuck a slide in there, so I'm probably going to be a little redundant on this, but in the ETFs, so SLV, GLD, have seen the largest outflow in a long time. So they saw this massive inflow pushing the price up. Now they take it out. That pushes the visible price down. But what's changed? What changed from a week ago? Absolutely nothing other than those that would have to deliver out the silver are scared because they know that the emperor has no clothes. They know that when push comes to shove, if they are forced to deliver out silver or gold that they cannot do because in the physical world there's a finite amount, then you're going to know that the emperor has no clothes. And they don't want you to know that because they want to keep this game going and stay in power. And so you'll see something kind of similar with gold, but remember that spot silver had a much more stretched run. So as you can see, when you're looking at this chart, it is still, the spot silver market is still 22% away from that 200-day moving average. So if 10% away is considered a lot, then 22% would be extreme. It doesn't mean that it can't go back to extreme levels, right? Because we're seeing the same thing in all of the markets. Why? Maybe we're in the melt-up phase that I've been talking about, which is the last phase before the crash. So here's the spot gold chart, and it is still 17% above that 200-day moving average. But like spot silver, the price is currently above both the 200-day moving average and the 50-day moving average. But can you see also in this particular chart how the spot price was suppressed because it went up, and I didn't draw this line in, but it went up and hit that resistance level. People get frustrated because they think, well, nothing's happening with spot gold or spot silver at times, right? But it could just simply be working off that overbought, not overvalued. Those are two completely different things, but that overbought position. It has to do that. But also, it really is about your perception, because a rising gold price is an indication of a falling currency and also, a looming crisis. They don't want you to understand this because they need you to stay in these markets. So it's a bit of all of the above. It is a bit of working off the overbought position, not overvalued, overbought position, and it still remains technically overbought. Understand that when it's also, we're in like this psychotic phase, right? Where one day everything is doom and gloom, and the trade talks and the debt levels and the defaults and this and that, and boom, there is a flight to safety into gold and silver. They want you to stay in the paper contracts. They want you to stay in ETFs. They don't want you to hold it physically. And make absolutely no mistake about it. If you own an ETF, you do not actually own physical gold and silver. All you own are shares in a trust that are designed to mimic or imitate the movement in the spot market, which does not represent the true fundamental value, 40,000 here and about 2,000 here. We're not even marginally near those. So you use any of these pullbacks because let's face it, nothing goes straight up. Nothing goes straight down. You always have to get bouncing along the way. And much as I know that for you watching and not really being a technician, that you like it when everything just keeps going up, and then you get nervous when there's a pullback. You need to understand, the more of this that they do, the less value that all of that money that they've already created out there has. That's the real trend, not stocks, cryptos, bonds, even gold, spot gold or silver going up. That's window dressing. The real trend is how they are devaluing the dollar. And as I've been telling you, woohoo, the devaluation trade is awesome. But what do we see? We see stocks hitting new highs ahead of the Fed rate decision. In other words, markets, corporations want the Fed, and certainly President Trump wants the Fed to lower the interest rates, which is really a cost on borrowing, a cost on this stuff, how much this stuff is worth. The reality is the lower the interest rates are, the less that value that has. Why? Because they want you to borrow and spend more. They want corporations to borrow and spend more. Why? Because that pushes more garbage fiat into the system, which then pushes the price of assets up. It also pushes the rest of the cost of living up as well. Then that makes the GDP look better, even as families are struggling to feed their families. But the GDP looks just great. This is what happens in the melt-up phase. Everything is ignored because there's just so much more of this in the system. And when they do that, that money has to go someplace, period. It just doesn't go into a vacuum. And once they create it, it's in the system, and then it's sloshing around. And it can go from this asset to this asset to this asset to that asset, driving up the visible prices of everything. But again, it doesn't matter. Look I've got this $10 trillion Zimbabwe note, and I can buy nothing with it. Because the reality is that any fiat money, its true fundamental value is zero. It is used in one place. These have never gone to zero. Why? Because they have full functionality and absolutely broadest base of demand. You decide what you want to go into this battle with. One place, every place. Give me every place. Give it to me. That's what I want. That's always what we want. So what about the physical metals? Well, the easiest place for me to show you that is through the PCGS 3000. These prices might be a little bit late, but it still gives you a really clear indication. This is the quality level that typically, and the date range that we typically use to build our sound money strategies. You can see pretty clearly, and I've shown you these charts before, you can see pretty clearly that cup formation, but we haven't broken out from the 2008 highs. However, we are still significantly below the 1989 lows. And that was when Wall Street participated. And I think it should be pretty obvious to everybody that Wall Street's starting to participate in the gold and silver markets again in a rather large way. And, you know, they've always got to find whatever that next hot thing is to push. This lies in the future. You want to participate? You better be holding it. Because the reality is if you don't hold it, you don't own it. And you know they want to digitize it, which I will never voluntarily do, so that ultimately you don't hold it and you don't own it. Don't fall for that trap. And they'll create a crisis to push you into it, just like they did in 2008. This is the way that they operate. So, while gold and silver that are just this raw stuff, right? So they kind of follow the spot market up or down. There's your opportunity. Yay, you want it pulled back. You don't want it overbought, but it doesn't really matter anyway. Honestly, the only reason why I ever look at the spot market is because I know you're looking at it, and I want to be able to answer your questions, and I want to be able to show you this on a technical level, because you need to keep a clear head and not believe the lies of Wall Street. It's amazing to me that anybody still believes the lies of Wall Street, how many times we've been burned. But this next graph, which is 10 years, you can see that cup formation and that breakout. So we've had the breakout, even though we're not at the 2008 highs. The biggest bargain in the bunch. Period. End of discussion. And that's what you want to look for, right? But there's different quality levels. This is just the 1 year. And that red line is the 6-month moving average. And you can see how steadily, let's see, can you see that in the one before that? So you can see that red line, which is that moving average, and you can see where that was above the spot price, and so the prices kept going down. But that shifted, and now it remains, oops, I didn't mean to do that. Now it remains well above. Can you see that? That red line is that 6-month moving average, and the blue line is well above that. But it's nice and steady above that, right? It's not spiking yet. That lies in our future. And it definitely lies in our future. I have no doubt about that. I have no doubt that we will more than test, if not surpass, those 1989 highs. Why? Because there's a whole lot more of this sloshing around in that system. And when it gets there, are you going to want to convert your gold, this stuff, back into this stuff? Let me tell you, you're going to be very, very aware at that point that this stuff is losing value really rapidly. But the only reason you're going to want to convert it is to convert this garbage into something useful, like, I don't know, income producing assets. And I will be doing a video on that, so I get more granular and more specific with the strategy and the exit strategy. I'm working on it, I promise you, because I want you to be able to make educated choices. You do not have to, I don't want you to take my word for it. I give you all of the links. Do your own due diligence, but we're here to be of service. Every single person at Zang Enterprises is here to be of service to you and meet you where you are and help you get to where you want to go. I think it's critically important. It has to be your choice, and you have to do what you are comfortable with, regardless of what anybody says. And I know we can make a difference. I know we are making a difference. And we will, at Zang Enterprises, of course, we support sound money and community on a global basis. And we will continue to create those tools, which I've been working on for a long time, to give you the tools to help spread the word so that we can get sound money back in the system again. It's got to be redeemable. It's got to be. If it's not, it doesn't mean anything. So until next we meet, please be safe out there. Bye-bye.